Greetings to all of you. I am Dr. Samir Barua from KKH and I am also the former General Manager for Indian Overseas Bank. Let me begin with a question. Why is the role of banks and the banking industry is becoming more crucial for our country? India is emerging as one of the fastest growing economies of the world with 1.45 billion consumers. We have 65% youth and the median age is 29. We have, since independence of our country, followed a protective regime where the economy was closed and the bank and the government was virtually doing everything. So government was the largest employment provider at that time. In 1990s, when the economic reform, the LPG reforms came in, the liberalization, privatization and globalization reforms came in. Privatization came in, and today the private sector is a major player in the economy, and privatization took place and is being encouraged today to come and play a leading role in our economy. Government of India is emphasizing on transforming job seekers into job creators. There cannot be a better organization than the banking organization, which can on regular basis provide both direct employment and help the job seekers looking for jobs, and the banking industry can also help in creation of jobs by helping the job creators who are wanting to become job creators by providing them with the necessary financial assistance and services and provide need-based credit to them in order to establish their enterprises and also in upscaling their existing enterprises to the next level. So this is how the banking industry has both the role of helping the job creator and also helping the job seeker. As students, you have two options before you. One is you can either become a job seeker or you can become a job creator. In today's context, the government of India is laying a lot of emphasis that there is need for us to become job creators. Now, in this context, today we will be discussing some of the role responsibilities of the banks, and also we will discuss on some of the issues relating to financial inclusion and credit outflow. Why we are emphasizing on credit outflow? Because, as you know, the banking industry is vested with the responsibility of providing need-based credit to our business houses, to our enterprises, both in the farm and non-farm sector. And I have prepared a few slides which will go around. We will take you around and then we will show you all this one by one. Banking in India. Banking plays a significant role in the Indian economy by providing financial services, facilitating trade and commerce, funding industry and agriculture. Besides providing banking services to the household sector, it also brings financial stability. Nationalization of banks, as you all may be knowing, it took place on 19th of July 1969. A significant shift has occurred in the role responsibility of the Indian banking industry on this momentous day. 14 major private sector banks were nationalized, marking a transition from class banking to mass banking. Under these directives, the banking industry was mandated to allocate a substantial amount of their deposits to the priority sector. In 1969, under the Get-Gill Committee report, a lead bank scheme was introduced in the Indian banking industry. Under a lead bank scheme, one of the objectives was for removal of regional imbalances and through appropriate credit deployment and address credit gaps in various sectors through a credit plan. We have credit plans at the block level, we have credit plans at the district level, we have credit plans at the state level. So in every state of the country, the lead bank scheme is applicable, under which there is a bottom-up approach where all these credit plans are dovetailed right from the block level to the district level up to the state level. And so the government is involved, the banking industry is involved in working out this detailed plan, and accordingly targets are allotted to various banks, and a lead bank is identified by Reserve Bank of India, by NABARD, and then they play a leading role in coordinating amongst all the banks in order to ensure that the targets are met. Lead banks were required to undertake initiatives in promoting financial literacy and educate the public about various banking products and services. The lead bank scheme is needed to support the economic development of regions and contributing to overall national development. In order to bring about reforms in the lead bank scheme, the Government of India had formed a high power committee led by former Reserve Bank of India Deputy Governor Usha Thorat in 2019 to address the challenges in the banking industry and also to cover all areas and sectors. Financial inclusion should be the goal. It should not be limited to government sponsored credit schemes. The focus is needed to be on the unbanked and underbanked population. Private sector banks should be included in the LBS action plans, especially in the areas where they are present. Each lead bank was expected to open a financial literacy and credit counseling center with posting of personnel of appropriate level and attitude, and that they need to be aware of the latest developments and emerging opportunities. I'll take next. We will discuss something on the bank lendings and issues observed. Banks under the priority sector lending directives of Reserve Bank of India are required to lend 40% of the adjusted debt credit or credit equivalent amount of off-balance sheet exposure, whichever is higher. This responsibility extends even further for regional, rural banks and small finance banks, where the requirement is set at an impressive 75%. Based on the Gadgil study report and bankers committee set up by the Reserve Bank of India, RBI launched the scheme in 1969. The objective of the scheme was to ensure financial inclusion and provide financial services to the masses. Under the scheme, a bank was given the lead responsibility of coordination with the other banks and financial institutions. The scheme was aimed to increase credit flow to priority sector and was designed to provide banking and credit to rural areas. So you can see that a lot of steps were initiated in order to emphasize on the need for inclusive growth of our economy. While finance is not an issue, access to finance from banks is remaining a big issue. Historically, bankers were vested with graded financial discretionary powers depending on the grade of the branches. While taking credit decisions in accordance with the laid down norms for lending, bankers were required to apply their mind while judiciously exercising their discretionary powers on the merit of individual cases. The banks have in place a deviation policy which can be exercised by reference to the higher authority. So, in banking, as we all know, we have discretionary powers given to the bank managers. And these discretionary powers are required to be exercised judiciously so that they are able to, so that the people are able to get the benefit of that. Now, as far as financial sector reforms, what historical perspective and legacy issues are there. The financial sector reforms part 1 in 1991 and part 2 in 1998 ushered in a new chapter in the annals of our banking history in enabling our banks to be globally competitive and acceptable. The banks had to align itself with global practices. The banks had to accept the income recognition and asset classification norms, prudential norms for lending. The Reserve Bank of India defined non-performing asset as a loan or advance that has been overdue for more than 90 days. The asset, loan or advance, when it ceases to generate income for the bank, this 90-day overdue standard was introduced to align with global practices. NPA is borrower-wise and not facility-wise. The exact duration may vary depending on the loan terms. For example, a particular enterprise, supposing they have a term loan for setting up of the enterprise and they have a working capital facility, loan from the bank for running the enterprise, if supposing the term loan becomes NPA, then automatically the other loan, that working capital loan also, is termed as a non-performing asset. That means it is not borrower-wise, but it is facility-wise. The classification of NPA is done. Following the acceptance of the provisions of the Financial Sector Reforms Part 2 in 1998, recovery of NPAs became one of the greatest priorities for all the banks. Government, in order to help the banks in faster recovery of the non-performing assets, came out with the legislation in setting up of the fast-track courts in the form of Debt Recovery Tribunal, and also enhanced the SARFAESI Act. These regulations were heavily loaded in favor of the banks, in which created a fear psychosis not only among such borrowers but also amongst the bank managers, who were subjected to disciplinary action by the higher management of banks on account of staff lapses identified for any acts of commission while sanctioning those loans, which later became non-performing assets. So during that period, because the recovery was the priority, was the topmost priority, a lot of non-performing assets were identified. And while identifying this, obviously being accountable to the public, to the government, to the public, the banks were required to look into whether there was any sort of omission and commission on the part of bank managers while granting such loans. So this created some sort of a fear psychosis amongst the banks, because suddenly they found that a lot of actions were being initiated, and that led to a situation where there was a lot of credit aversion and risk aversion in the minds of the bank managers. This situation resulted in the top management of banks introducing committee-based sanctions, and in some of the banks, reportedly financial discretionary powers generally vested with the bank managers were withdrawn, and banks also had to set up credit processing centers and introduce system-generated credit processing and sanctioning of loans. This is what is in practice today. These centers generally were away from the bank branches. Such measures caused a lot of problems for prospective borrowers seeking bank finance, more so for the entrepreneurs in the villages. The percentage of gross NPAs of banks rose, and the banks in the first 1 or 2 decades of the century, with the concerted efforts ably supported by Government of India and Reserve Bank of India, could recover huge amounts of NPAs, and thus the gross percentage of NPAs came down, and the banks were able to turn around and register profits. The Debt Recovery Tribunal and SARFAESI Act, out-of-court settlement, one-time settlement, and low cuddle all came to rescue the banks in the recovery of NPAs. Banks were adequately recapitalized, in enabling them to carry on their lending activities, more so to the priority sector. Today, the banking industry have enough of liquidity, and all that they require is the much needed willingness to lend. The new generation of entrepreneurs are needed to be handled with care and understanding. The bank managers must come out of the historical mindset and legacy issues of disciplinary actions which the banks had to take post 1998, in wholeheartedly coming forward to proactively in extending need-based timely credit to the entrepreneurs both in the farm and non-farm sector of the country. This is becoming a very important matter, because on one side, if we are telling that transforming job seekers is into job creators is the mantra, then obviously the banking industry has a larger role to play to come forward proactively and to see that they are able to give need-based credit to our young entrepreneurs. Now, there are a lot of complaints coming stating that when they go to the banks on the basis of, on some pretext or the other, the proposals are getting rejected or it is getting underfinanced. So there is need for a lot of research work also for the students to look into and see what sort of research on banking can be done in order to address all these issues and challenges. There is huge requirement of banking research in this country. Private sector banks, the RBI issued new guidelines in 1993 allowing private sector banks to enter the Indian banking system. It is not that the private sector banks were not there in the past, because before nationalization we had private sector banks, and out of that 14 were nationalized, as we all know. So today in 1993, the government came, the Reserve Bank came with new policy guidelines on establishment of private sector banks, and today the private sector banks are a major player in the banking industry in the country. We have today about 12 nationalized banks, public sector banks, and we have about 21 private sector banks. Total, we have almost about 141 banks in the country. The issues and challenges on financial sector reforms, financial inclusion issues and challenges. Financial inclusion as defined by RBI is the process of ensuring access to appropriate financial products and services needed by all sectors of the society in general and vulnerable groups such as weaker sections and low-income groups in particular at an affordable cost in fair and transparent manner by the mainstream institutional players. The objective, we have already covered that. The objective of the lead bank scheme was also incorporated that they will also have to take in financial literacy and financial inclusion to take it up very seriously now. So the credit deposit ratio issues and challenges. So what is observed in more so in the northeastern states, we have seen, of course it is there in other parts of the country also, out of the total MSME, micro, small and medium enterprises, you all know that out of that the distribution of the micro sector is very large. In some states it is even up to 99% of the total MSME. And so this is an area of concern where we will have to find out ways and means for formalization of the unorganized micro sector, because they are remaining in the unorganized micro sector. They are not able to raise finance from the organized banking industry. Under the directed lending, like government sponsored programs and all these things, they are for as a one-time measure, government is giving them some lead, but then that is not sufficient for them to go ahead with sustainable businesses, because for that they require line of credit. System-based credit sanctions. Now on this also a lot of discussions are going on, because you will also as students have to study that. What is this system-based credit sanctions, and are the software used for credit processing and sanctioning, are they very rigid? That is again a subject of study which as a student community you can look into and then study on that. As far as CIBIL credit score is concerned, here also the issue is there are two segments. One is the personal segment, other is the business segment. As far as the personal segment is concerned, it's like offering credit cards or personal loans like cars and housing loans, education loans. These are all coming under the personal segment. On the other side is the business segment. There is CIBIL rating credit score is there both for the personal and for the business. The personal is normally from 300 to 900, and as far as business is concerned, that is from a parameter of 1 to 10. Now, here again the issue that is there is that when a customer, when an entrepreneur goes to the bank with a business proposal, even if it is at in a score of 1 to 10, it's 10, but still then the bank manager or the bank policy looks into the CIBIL personal score, and if they find that the personal score is low, then in that case what happens? The proposals are getting rejected. So this is again a subject for the students to look into, the researchers to look into, and find out whether there is any sort of necessity for when the business parameters of CIBIL is there, whether there is any necessity of looking into the CIBIL score, personal CIBIL score, because the person is that the entrepreneur is not going for a credit card or is not going for a personal loan. So here this requires to be looked into. Other issues on increasing credit outflow is, as you know, the banks, even though in the lead bank scheme it was said that the regional imbalances have to be reduced, but unfortunately what is happening, the credit deposit ratio varies from state to state, because banks find wherever their credit absorption capacity is more or where the demand for credit is more, they invest their funds, because they cannot keep their funds idle. But now it is necessary that under the changing circumstances, when a lot of emphasis is given for development of every state and for infrastructure development, so there is definite demand for credit in the underdeveloped states also, which the banks will also have to look into. This is what we said, that formalization of the unorganized micro sector is very essential. The system-based credit sanctions needs to be looked into. CIBIL, as I already stated, this is also required to be looked into. Issues are there is need for settling up more. There is need for opening up more branches, especially in Northeast India. We find that the number of bank branches, because the villages are in the remote places, there is need for the banks to look into and see that whether they are able to open more branches, and also at the same time they must strengthen they must strengthen the infrastructure and manpower of the rural branches, because without that they are not able to go and serve the villages, the number of villages that have been ceded to them under the lead bank scheme. So here internally, since I am from the banking industry, I do understand that the concern of the management is that they do not want any loss-making branches in the villages. So for that purpose also, there is a transfer price mechanism which the banks can follow and see that whether they can compensate for the losses of the rural branches in looking into the subject of providing inclusive growth in the villages, where there is a lot of requirement for the banks to come forward and help our people. Today, as you all know, the banking industry is undergoing a lot of changes. Today, technology has come in a big way in the banks. And days are not very far when we may be having technological companies offering banking services. That is the scenario. From brick and mortar banking, we are going to virtual banking. And the computerization process in the Indian banking, public sector banks, it started gradually sometime in the year 1985. There was considerable delay in introduction of computers in the public sector banks, primarily due to a lot of resistance from the trade unions, associations, as there was a lot of apprehensions that computerization would result in large-scale displacement and lead to severe unemployment problems. After protracted deliberations and assurances, the computerization process started. The computerization started with the introduction of ALPMs, automated ledger posting machines, followed by TBA, total branch automation. Then came the CBS, the core banking solutions, and today we have digital banking. So today, nowadays, you are finding that even through our mobiles, we can operate our bank accounts. It's not necessary for us to go to bank branch. Everything is made online. And thanks to the government for the initiatives taken in development of the technology and also in upgradation of the technology. And apart from that, also that connectivity issues, even in far-flung areas of Northeast India, also you'll find that connectivity is there. And through connectivity, we are able to go out with our outreach programs, whereas it was not possible for us to go to every remote villages. But today, with technology, we are able to access into the villages and provide banking services doorstep for the people. But as already covered, there is, even though technology is there in a lot of states where remote villages are there and issues of livelihood is there, so there is necessity for us to strengthen the infrastructure and manpower of the bank branches also, so that human touch is there. At the same time, they are able to understand more realistically the problems that's being faced by the people, so that they can come and provide the solution through manpower intervention, through technological intervention. There is need for setting up of more bank branches. There is no doubt about that we have been talking on this, that what are the issues here, that we need that credit should be available to our businesses, to our enterprises, both in the farm and non-farm sector. And for that purpose, the banks will also have to find out ways and means in order to see. As you all know, banking is both theory and practice. There are a lot of practices which are bankable in nature. And it is necessary for the student community, the bankers also, to go into a lot of research work on this, to find out ways and means how it is possible for us to leverage the technology, and also to see that the practices which are being followed by the people in far flung villages also, how it can be brought under the schemes of the bank for lending. Because through studies, we find that a lot of rejections are taking place by the banks on the plea that they are not as per their scheme. So there is need for both top-down policy interventions for the top management of the banks. On the other side, there is requirement for a bottom-up approach, where the people at the grassroots level, they must be able to feed information to the banking industry, so that they are able to escalate it up to the higher authorities for formulating such type of schemes which are in conformity with the needs and aspirations of the people and the economy of the state. The subject of localization and the subject of customization of loans is becoming very necessary, and thanks to technology, the technology can help us to a very large extent in understanding, because as we all know, we are in a data-driven economy today, so we need the data. And for that purpose, thanks to government again for the higher education institutions coming forward with a lot of outreach programs, with academic credits given to the students, a lot of flexibilities are there. So there is ample opportunities for the student community to take advantage of all these policy interventions and to see that how is it possible for them to take it forward and not only help themselves but also help in the inclusive growth of the economy. So as an adjunct faculty of Tezpur University also, we are taking up some projects where we are collaborating, we are leveraging the core competencies of various organizations and collaborating to bring about some rural transformation in the form of model villages. I think KK Hendricks State Open University is also undertaking a lot of initiative in this regard. And this is where the student community can play a leading role by in collection of the primary data. Because none of the organizations in the country, they have enough of manpower. And here in the university and higher education institutions, we have a lot of manpower in the form of able, educated youths who can collect the primary data, and through technology, through blockchain, we can analyze the data, and at the same time, we can, with this data, we can come out with more sort of constructive approaches, and we can also ensure that we are able to bring about that much needed inclusive growth of which we are talking. So as students, I request all of you to be involved in this. Go through the new education policy. You please go through what are the provisions under that. You find out what is the role that you can play in order to help the banking industry also to come forward with the customization and localization of policies. I think this is very essential for all of us to understand. So thank you very much for being here. And before I conclude, there is need for creating greater amount of awareness in the minds of both the banking industry personnel and the entrepreneurs, prospective entrepreneurs, on the increasing their level of awareness about the loan policies, products, and processes, procedures, so that they can legitimately have access to hassle-free bank finance. As students, my submission before you is this, that you must go through the Reserve Bank of India website. You must go through also the loan policies of banks, understand the policy needs, what they are wanting. Because in most cases, what we are finding when we are asking the youngsters, like the students who after passing out are interested to go into business, we are observing that they are going to, in today's context, we must understand that the bank manager is not the bank. We must understand that he is the representative of the bank. He is guided by rules and regulations, policies, norms. And today, thanks to information technology revolution, everything is available in the website of the banks. So before we approach a bank for any financial assistance, my humble submission before all of you is this, that you must please go through the website of the banks and go through the loan policies of the bank. Because in many cases it is found, because I am associated with the entire entrepreneurial ecosystem of Northeast and have been as a mentor guiding a lot of youngsters in their journey on the business enterprise, we are observing that many of the bank managers, I'm sorry to say, are also unaware about policy provisions which are flowing in from the top management. Consequent to that, what is happening, based on their earlier knowledge, they are rejecting proposals and on some pretext or the other. So today's entrepreneurs and here, earlier entrepreneurs, the difference is this: today's entrepreneurs must be well informed. You must be well informed, and at the same time you must go through the loan policies of the bank and check up on the provisions for which your proposal is related, because everything is there. Once you know that yes, a policy is there for bank to help this type of an enterprise, then you go to the bank. When the bank manager says on some pretext that nahi aapka hoga nahi hoga, ya it will not be done, no, you cannot do it, then you can point out by showing it to the provisions in the policy. So there are a large number of entrepreneurs who are getting the benefit from the banks because they have been well informed about the loan policies of the bank. So out of ignorance, if we go, then in that case, there can be possibilities of their being misled also. While I am appreciating the banking industry for the huge sort of contribution that they have made in the economic prosperity of our country, at the same time, there are issues and challenges which is required to be solved by the higher education institutions carrying out a lot of research work on banking, and also to address the issues and challenges that are being faced. And in today's context, it is becoming more important because, as I had said at the very beginning, what was there? The historical perspective was what? Since independence, we were in a protective regime. And since 1990s economic reforms, we have opened up the economy, and that's why the private sector is required to play a larger role in the development of the country. So under these conditions, that is why the mantra of the government today is that transforming job seekers into job creators is very, very essential for all of us to understand why the necessity has come. The genesis is this, that today we are allowing the private sector to come and play a positive role, a more development role as far as the economy is concerned. Under this context, you all as students have a huge opportunity. I can tell you that because we have a lot of domestic exposure, international exposure, I can assure you that the future lies in India. We have huge opportunities. And these opportunities, because of lack of technology, because of lack of capital, we were not able to explore or exploit. But today the scenario is undergoing change. As you must be observing that every state government is now encouraging foreign institutional investments and foreign direct investments. Why? Because they all feel that yes, these are sources of funding which can help the economy to grow. And banking industry in all cases are directly connected. As I said in the beginning, bankers can provide both direct employment, as you know, that regular years are going on, regular examinations and regular interviews are going on, and banking industry is requiring a lot of manpower, and for that purpose IBPS is undertaking a lot of programs. On the other side, the bankers in providing job for the job creation, they are the only sort of organizations which can provide you sustainable finance for taking up your enterprise. So while appreciating this role of the banks, while appreciating the efforts that they have taken, but we still have a long way to go. The bankers will also have to look into, come out with their findings, and then since banking is both theory and practice, they must be able to see that what sort of practices are there which are bankable in nature, which can find a place in the scheme of things of this bank. And thank you very much. We will come again when it is required, and then if you have any sort of queries and doubts, etc., that you can put it across to the Crystal Capital Hendricks State Open University, who are doing an excellent job, and then helping the student community to come out through the open distance learning facilities and other facilities. Thank you so much.